Welcome, everybody, to the webinar for Solana Apartments located in Indianapolis, Indiana. We're going to get started here in just a minute at noon. I'm going to wait for just a minute to start on time, but then we're just going to get into it so we have time not to get through the deal, why we absolutely love this opportunity, but also want to make sure we've got time to answer any and all questions that folks have if you're considering making an investment into Solana Apartments in Indianapolis. Feel free to enter any questions into the chat. I know Griffin, Investor Relations Associate at Great Capital. A lot of you probably already know Griffin. I know he's in the chat, ready to answer some of your questions. But then I'll also be getting to your questions as soon as I can, as I'm getting through the presentation. If I've got a time, in the middle of it, I'll hop right into it and address it. If it's appropriate for later on in the webinar, I may hold off until the end, but please feel free to just drop your questions again into the chat, and we'll get to them as soon as we can. All right, well, it's noon. We're going to get started. I appreciate you taking the time on this busy Thursday, a little bit off the Memorial Day weekend. Hope everybody had a really nice, relaxing time, family and friends. This last weekend, I know myself and the Great Capital team that kind of needed it after an incredible week. Last week, we spent a good chunk of the last week on site at Solana conducting our physical due diligence. We're in the middle of our financial audits and lease file audits to just, to make sure everything on the rent roll and on the leases are checking out. We'll have compiled reports most likely by the end of this week, getting into next week. And again, the most important thing, if you're all interested in Solana or just interested in Great Capital maybe in the future, is making an account on the Great Capital investment portal. I think it's one of the best portals that I've seen in the industry. And you go to greatcapitalllc.com, you'll see a button to create a new account. Go ahead and create an account. You'll get access. And in that, once you're on the portal, that access will allow you to download the deck, due diligence materials, as we load a bunch of what we see just directly into the portal so you can conduct your own due diligence. You can schedule a meeting with the investor relations team, check off all your boxes, make sure it's the right fit for you, and then complete your entire investment all in the portal. If you run into any issues, never hesitate to reach out to the Great Capital team. We're more than happy to walk you through the process. It's relatively straightforward, but we want to make sure that we're able to help you out and get through it, relatively seamlessly. All right, well, with that being said, let's just get in and start discussing this latest opportunity. If you've been tracking the multifamily market, you know that deals have been scarce over the last kind of 18 months for a lot of good reasons. Prices had been way too high, and then as interest rates, starting in March of 2022, started increasing materially, well, it really froze the market as prices were too high, interest rates were too high, and just the deals did not pencil. Now, while there were plenty of groups that were still out there buying deals, collecting fees, and no one knew that interest rates were going to rise so much, but Great Capital, we were a little bit different in that we really held off and stuck to our return criteria and saw very quickly that these deals don't make sense and would rather just go over a year without doing any deals than getting into the wrong deal. And that's, I think, for several reasons, we are much more aligned in terms of interest with our investors. We're major co-investors, which we'll get into the details on Solana and what we're putting in ourselves. But we're looking at the LP returns. We're looking at risk mitigation just the same way that you are when you're looking at making an investment. And almost on every single deal, the GP group, which is myself, my executive team, member of my family, we're the largest investors in the deal. That's been the case for the last several projects, and I think it's going to continue, although we do have a large investor in this project. So they may have beat us out, but this is also one of our largest equity raises at $27.5 million. I'm excited to say that we're over 60% raised on this project, having a little bit over, basically right at $16 million out of that 27.5. So there's clearly a lot of interest, a lot of folks who invested in our last offering down in Evansville, Indiana, River Club Apartments. We're excited to invest in Solana as it's an incredibly accretive pairing, investing in a value add project in a more tertiary market with a lot of upside potential. comparing that and pairing it with an investment into Solana Apartments, which is an A-class, really core plus opportunity in a secondary market of an incredible growing Indianapolis, Indiana. So before I get into all the details of Solana, why we're just so excited, we love the deal. I think it's a great opportunity. I first wanted just to highlight a little bit about kind of how we were able to get this deal under contract. It's one of the biggest questions is, tell us the story of this project and how are you guys able to get such a good deal? Because as you can see on just some of the metrics that we're highlighting here, we're buying the Solana for $178,000 per unit for 2014 Class A asset, an institutional size and quality project at an incredible location in a very sought after market. So I want to get into that whole story and how we're able to drive those returns because of our basis. Just before I do, I want to just highlight the timeline, where we are in the process. And so you're just well aware of, when you would need to make a commitment if you're interested in investing in Solana, and then when that capital call will be issued and when we are looking at closing on the property. As you can see, we went under contract just last Monday. On May 20th, we are in our due diligence period, the last 30 days. That's going to expire basically right at June 18th. We're looking to have all of our capital raised well prior to due diligence expiring in the middle of June. We really are looking to have all of our capital committed. We're shooting for by the end of next week, kind of at the latest. So again, if this checks all of your boxes, you've been looking forward to doing a deal with great capital. Maybe you've been looking for a multifamily opportunity, trying to get into the Indianapolis market because we've been on the top of the list in terms of rent growth, stable economy, etc. Don't wait too long. I would make sure you make your commitment, sooner rather than later. And then if you'd like to have a meeting with the investment team and myself, make sure you schedule that today by going either to solanaindy.com or just graycapitalllc.com, and we can get that all set up for you so we can close on July 25th. And as you see, we're going to issue our first distribution before August 31st, because this is a cash flowing asset. We're targeting 6% cash on cash return in the first year. We do monthly distributions, and we're going to issue that first distribution at the end of August. So before we get into more details on the deal, as you can tell, I'm excited. I'm going to play a video just to give you a little bit of a taste of Solana, the property, while I kind of just tell the story of kind of how we got the deal, going back really to the inception of Solana. See, it's a beautiful property right on the banks of the White River on a 22-acre private bay, 20 boat slips. Solana was originally developed back in 2009, but only 3 buildings were built at the time, and they were built exclusively as high-end for-sale condos. Well, the great financial crisis kind of had another opinion of what this property was going to be, and ended up being a failed condo project, and ended up eventually being purchased by local apartment developers who added the additional units to bring the total unit count to 384 market rate apartments. All the condo association was completely dissolved. There are no more condos. It is all market rate multifamily units. Fast forward through 2 separate owners. The current owner purchased the property back in 2019 for $63 million. Obviously, before 2019 was just before the huge run-up in valuations and pricing. And, I'd love to be able to go back in time and be able to buy more assets at 2019 pricing, which is just about what we're able to do today. The current ownership group is an institutional owner. They typically hold their properties for 3 to 5 years. This property is part of a fund, and they are at the end of their hold period, just the end of their cycle. They typically don't hold for any longer than 4 or 5 years. Well, they first brought the property to market back in November for $84 million. And again, great capital, sticking to our underwriting criteria. We just thought we were too far away, But that wasn't uncommon for a lot of the deals that we saw all throughout 2023 and half of 2022 is that, we were just significantly further away from what the brokers and the sellers were looking for. So in November, when they came out at 84 million, we were out. It just didn't work for us. We'll fast forward into early 2024. They had taken the property off market, and when they brought it back on, they were looking to get in kind of that mid $70 million range, which was closer for we were trying to get, somewhere in the $60 million range. But we were still far away. So, we started putting in offers, and fast forward, we're getting into the second round of bidding. And frankly, we don't think that we're going to get the deal because, again, our opinion is, make us buy it. Our number is our number because we have to hit the returns for our own capital, our investors' capital. And given that this is going to be one of our largest equity raises, we need the returns to look really good so investors are actually interested in the deal. We're not at the point, even though we've got a long track record that I'm going to get into with a lot of success, a lot of deals, we're not, at the level of a Blackstone or even some of these other, maybe smaller groups who can do a bunch of deals and have low returns and have investors that, just need to clip a little bit of a coupon and don't care that the returns are that great. Even if we had access to that type of capital, I'm the type of person I don't like to do deals just to do deals. And in fact, that was the first thing I told Jay Reeder, our chief investment officer, when he joined the team back in 2020, is we're never going to do just to do a deal. We're never going to do a deal just to get a fee. These have to be high quality deals, because if we're not doing good deals that I'm excited about, I'd rather just not do the deals at all. I've been a passive investor as an LP. I've invested as a co-GP with low overhead. I built great capital because I wanted to do something a little bit different, a little bit better, serve investors in a way that I would want to be served as an LP, seeing different operators and how they worked. And I said, how could this be done a little bit better? So we're just not in the business to do mediocre deals or do average deals. We want to do incredible deals. So again, back to the story of how we were able to put this project under contract. As we're negotiating, we're basically at a $69 million offer, which is basically the top of we could do. There was another bidder apparently in the $70 million range, between $70 million 500 and $71 million, somewhere in that range. We don't know exactly where. Then all of a sudden the 10-year Treasury starts spiking. This is about a month ago. Gets over 4.77%. There's talk maybe it's going to run to 5%. If you remember, again, just a couple of weeks ago, about a month ago when that was going on, the market got spooked. The idea of going back up to 5% was going to kill a lot of deals. And even though that we were pursuing an assumption of the loan on Solana, it raised a big question of, if we wanted to go with a new loan, and that's how some other buyers were looking at it, the returns start looking not nearly as attractive as interest rates go up, as you can imagine. You can't get the loan proceeds, the cash flow decreases. So, certainly our price can't go up. So when we were told that we could be awarded the deal if our offer was at $70,500,000, I said, look, I can't do that. In fact, we actually lowered our price. I can't do $69 million anymore. We resubmitted our offer at $68 million. I said, look, you're going to have to make us buy it because we have to have the strong returns. The market's spooked. And this has to be a deal, just a legitimate deal that no one could even look at and say, oh, you guys are overpaying this. That's just where we are in the market. Fortunately, we had just closed a transaction with the broker who was controlling Solana. We just closed River Club, which is our latest acquisition down in Evansville, Indiana. We executed. We closed on time. Very successful. That was our third transaction with this broker group. So we're a known quantity, and we were the preferred buyer. So even though we were the lower bidder, it was suggested that if we can just come up $250,000, it would be ours. So that's what we did. We resubmitted at $68,250,000, and we were able to put the property under contract on May 20th. Again, because everyone's been asking, how are we able to find such an opportunity? Why did they sell? That's why I wanted to give you that context about Solana first, before I get into all of the actual analytical details of why it's a huge opportunity. The rents are way below market. It's got an unmatched amenity set. It's a beautiful property. As you can see from the videos, really, it shows incredibly well, but there's a lot more to it than just the way it looks. But just before I get into all the details of Solana, I want to tell you a little bit more quickly about Gray Capital. and then we'll get into the details. But first, again, you're betting on the jockey, you're betting on the firm and our ability to execute. You're not investing in the deal. Obviously, the deal's got to make a lot of sense, but if you know what we do and what our core principles are and what we look for, we want you to invest in great capital, not necessarily the deal. Certainly, the deal has to look good. Here's our track record: 16 active projects, 9 full cycle projects, average IRR of 34%. This is great. I'm very proud of this track record. I'm going to move on from it very quickly because this is not really, I'm proud of this, but don't do a deal with us because we've got a 34% average IRR. A lot of groups have high average IRRs because the market was so good. It was too easy to do good deals over the last cycle. Let's just be honest about that. We were projecting, 15 to 16 to 17% IRRs on all of these deals. Would have never expected cap rates to come down so far. And it just doesn't tell the whole story. So what I'm proud about is first, just the team that we've been able to build. Since starting the firm back in 2015, when I founded it with my wife, Alex, growing the team, bringing Jay Reeder on back in 2020. If you know Jay's just incredible asset to great capital. I mean, one of the best acquisitions and asset managers that you can find in the business. But we've been growing since then. We brought in property management and construction in-house back in 2021 and 2022. And since then, we've been continuing to grow our corporate team. Happy we just made a new hire of a new regional manager that can add to this list. This is just our corporate team. We're over 50 total employees right now, including our site staff on our great residential teams. But besides the people itself, it's not the things that we did do. It's not the deals we did, because a lot of people did good deals. That doesn't really separate us from anybody else. Let's be real. What separates great capital from other syndicators, other operators, are the things that we did not do during the last several years, as inflation has increased, as interest rates have increased 525 basis points from where they were back in 2021. It's our ability to understand risk, mitigate risk, and manage risk. So capital preservation is our number one priority. Again, we're putting our own money into these deals. It's not like we're just rolling our fees in. In fact, our actual dollars in far surpasses our fees from the project. We've never issued an unplanned capital call ever. We have no anticipation of doing so. We are not distressed. We don't have loan maturities coming up. The one bridge loan that we had, which was a holdover from when we were utilizing bridge loans for value add deals appropriately, was a property that we have down in Forest Ridge that we executed our business plan as interest rates rose, refinanced to do a cash out refinance, increased the value of the asset by over $5 million. And we're finishing up our monthly reports as we speak. I had have a conversation with Blake Peroni that's sitting right there in our office, and it had the best month of its history of inception. And this is in a time where rents have slowed down across the country and there's a lot of supply coming online, but where other operators paid too much, over-levered and overextended, and are facing distress and capital calls, the one opportunity where we could have gotten into trouble, we operated our way out of it. We executed on the business plan, and we're going to see continued success for a long-term hold on that asset. But we did not pay up. We did not overextend, and we just aren't finding ourselves, worrying about the next capital call we're going to have to issue. And that's really what I'm proud of, is the pitfalls that we saw and we avoided. Even though, it looked like there might have been some gold at the bottom, we have to move on and maintain quality. So also, it was challenging last year. Inflation, costs. We had to completely redo our budgets, March of last year, because we were living in a different environment. So we're flexible, we're hands-on, and we strive for excellence. Not that everything's perfect. We've got a lot of work to do, and continuing to improve and optimize. But we have our eyes set on being the absolute best. Okay, and then just really quick. This isn't our first time doing deals like this. We've a project up in South Bend, technically in Granger, Indiana, Villas on Fur. We're distributing 10% or more cash on cash every single year. This is a new 2019 built asset. And so it's an example of how we can operate these assets better to produce high levels of cash flow, even if it's a newer asset that looks like a trophy asset. Pinnacle on Meridian is an example of a more opportunistic investment we made early on at Great Capital when we were doing our own deals back in 2020. It was a condo deconversion. This is actually right down the street from Solana. We were able to achieve, when we sold it for the highest price per unit that Indianapolis had ever seen in terms of an apartment sales comp. So let's get into Solana, and as we do, let's talk about the Midwest and Indianapolis. Solana is located on the north side of Indianapolis, which is the more affluent side of Indy. It's home base to Gray Capital. Our office is just down Keystone Avenue from the property. We're just a little bit north of downtown. But I'm sure you've heard it, especially if you've been following Gray Capital, the Gray Report, or just reading the news. But the Midwest, Indianapolis especially, but the Midwest in general, is going through an absolute renaissance, driven by manufacturing because we have great affordability compared to the rest of the country, business friendly, low tax, and we have the employment base that is set to engage in these new manufacturing jobs. Just look at these charts, the jump up in 2022 to 2023 of manufacturing jobs in the United States as these factories and facilities are leaving China and coming back to the United States. It's every couple of days I see a new announcement from a new semiconductor plant or a battery or an EV manufacturer. Eli Lilly last week announced that they were going to invest an additional $5.3 billion in their new facility on the northwest side of Indianapolis in Boone County. That's incredible. And we keep getting these announcements all the time. And we are just at the beginning of this process. In the Midwest, we don't have to deal with hurricanes, extreme weather, earthquakes, which keeps our insurance relatively low. In general, it's just a much more stable environment. And frankly, because the Midwest had challenges in the 70s and 80s as manufacturing was leaving, the markets that have been able to survive had diversified over the last several decades into other industries, providing a much more solid foundation of economic growth and not just relying on one specific sector. But we're also primed, keyed, and tooled to grow in terms of manufacturing. We've got the water, we've got the land, we've got the people. We're doing it right now in the heartland and especially in Indiana. Again, why we love Indianapolis. Again, it's affordable, business-friendly, tax-friendly. We're a huge logistics hub. FedEx has their second largest hub in the world in Indianapolis. I think more cargo aircraft go out of the Indy airport than any other airport in the country. You can get to 80% of the population of Indianapolis within a day's drive, which makes it incredibly a strategic location. Tons of universities from IU, Indianapolis, Purdue University, Indianapolis, Marion University, Indianapolis University. There's several others that I'm not going to mention, but strong, educated workforce. Some of the highest rated suburbs nationally, just north of Solana and Carmel and Fishers. Again, it's a great city to live in. I was born and raised in Indianapolis. I've lived in New York. I've lived in Florida. I came back to Indy to raise my family because it's a great place to live. It's affordable, and I just love it here. Some of the major employers in Indianapolis, I mentioned Eli Lilly, Roche Diagnostics, FedEx, Allison Transmission, Rolls-Royce, and many others. In terms of kind of demographics and really apartment KPIs in terms of rent growth, Indianapolis has always had robust and stable job growth. If we go back to the pandemic, where basically every city in the United States lost jobs, Indianapolis saw the second least amount of job losses in the entire country. I think we were just behind Salt Lake City. Stable population growth of around 1%. And Indianapolis has been one of the top rent growth markets in the country over the last year or so. I remember Paul Fiorilla, who is the economic director at Yardi Matrix, which is a major apartment data firm. I've interviewed him several times. And back in 2022, about halfway through, he reached out to me. He said, Spencer, I need you to explain what is going on in Indianapolis. He goes, the data is jumping off the charts. He's like, I've never really dug into Indianapolis that much because it hasn't been on the top of the charts. It's always been in there, but it's kind of been in the middle of the pack and always growing. But it wasn't like the Phoenixes and the Austins and the Atlantas. And all of a sudden, Indy was. And I had to explain basically what I just explained to you about the affordability, the low tax, the diversified economy. But it's happening, and it's taking a lot of the country by surprise because so much attention has been on the Sun Belt. It's been on the coast. It's been on markets that maybe you're more familiar with, not flyover country which the Midwest often gets labeled as. All right, now let's get into the deal. If you have any questions on demographics and data, I could spend this entire webinar just talking about the data, and I want to be conscious of everybody's time. So I want to talk about the deal, why we love it, and answer your questions. Prime location on the north side of Indianapolis. We're just south of the nicest mall, Keystone at the Crossing, which Simon Property Group, Simon Malls, is also headquartered in Indianapolis. This is their flagship mall. It's the nicest mall in the state, and it's also surrounded by some of the best employers in Indianapolis as well, around Keystone at the Crossing, but then just a little bit west to the Meridian Street corridor. The property has an incredible amenities. I mean, the incredible resort-style pool, which you've seen in the video. I have some other pictures. Incredible workout facility. The clubhouse has been redone by the current owner. Dog park, all the amenities you'd expect to see at an apartment community, a brand new apartment community as they would build it in 2024. Not a whole lot of difference on the amenity set. What Solana has, though, that no other property in Indianapolis has, is access to the beautiful White River on this 22-acre bay that directly connects to the river, and a 20-slip boat dock in a marina. If you want to live in nature and have a much more scenic and tranquil setting, you're not going to find it in any of the nearby comps, which we'll get into in a little bit. Solana is absolutely unique in that regard, is that the setting is absolutely unrivaled. And it's not like you have to go way outside of the city to get it. You're in the city at very strategically convenient location on Keystone Avenue. So you can get into the suburbs within less than 5 minutes. You can get downtown to Indianapolis in also just about 20 minutes as well. We've got a value add strategy. I could make the argument that we just buy Solana at the current basis, operate it really, really well, and it would be a great deal. That's probably the case, but here's the problem with that. Solana, it's going on 10 years old, and while it looks great today, we're looking at around a 7-year hold period. Call it 4 to 7 years old as the whole range, but really we're targeting 7 years. In a couple of years, the paint, while it's starting to peel and chip a little bit, it's not going to look better in a couple of years. And so we not only need to cure any deferred maintenance now so we can have a great run and have the best curb appeal possible over the next several years, we want to stay competitive to the new supply that's coming online. And also when we go to sell the property, again, 5-7 years, we want the property to look really fresh, to pop, and for the next buyer to see this as more of a turnkey opportunity, although there's always, you can find some more meat on the bone. But in addition to just curb appeal, we're doing a strategic and surgical light value add on the interiors of the units. Again, really to make sure that they are modernized and can compete with the nearby comps, because most of the components of the finishes are about the same. We're just going to do a couple tweaks. And so when a prospective resident tours the nearby 2024 build construction, they're going to see it. It's going to look nice. It's going to look new. It's going to be $600 or more than Solana. Then they tour Solana. The features are the same. The amenities are better. They're getting a huge discount on the rent. The value proposition, I think, will be overwhelming to many prospective residents. And why I think even though we are moving rents in the first several years, I think we're being conservative on where we can take the rents over time. Couldn't be underscored enough. We're getting a great deal. I talked about, the $178K per unit, but what is that relative to? And I'm going to skip over the competitive edge because I've talked about that and the investment appeal. You guys probably can see the appeal. I'm going to just jump ahead of my presentation. I'm going to show you about the location, but let's look at some of these sales comps. So again, you're hearing me say we're getting a good deal, but what's actually some of the history in the area? These comps are taken from the last several years. We've redacted the names of the properties because it's proprietary information, got directly from brokers or folks who directly have knowledge of these sales. I mean, it helps being local, knowing all the players, knowing all the brokers. So looking at kind of the average per door sales price in the Indianapolis area, you can apples to apples comps. You can look at the average year built of this list is 2013, a year older than Solana. The average sale price is $252,000 per unit. That's comparing the sales price or our purchase price of Solana at $178K per unit. That tells me two things. Oh, and did I mention that the units are bigger at Solana also? And so relatively it's even better. But the two things it's telling me: one, we're getting a good deal. And two, when I look at what our sales price is to be projected in 7 years, I think right now, using our assumption of a 5.5% cap rate at 7 years and our NOI assumption, we're going to be selling it for around 280,000, which is only 30,000 more for where properties were trading for 3 years ago. And I think that in a 10-year time period, I think it's more than reasonable as we increase net operating income and moving rents over this long hold period. I mean, there were properties, as you can see on this list, that were already trading for well over our targeted sales price in 7 years, but they traded for a higher price several years ago. Several properties traded, well above the 250 range, kind of into that 280 and even the 300 range. Several properties traded for $300,000 or more. One even traded for $400,000. I think that is certainly an outlier, but it shows you, I think, the value, just the intrinsic value of Solana that we are able to achieve. More about, I just want to show you physically, because I haven't showed you a map yet, and why we love this location. I live about 7-8 minutes away from the property. I know it well. A lot of the team members live about 7 to 10 minutes away as well. So we're right on Keystone, at the Keystone Avenue, which is one of the main north-south avenues in Indianapolis. And on this map, we really wanted to highlight some of the neighborhoods in the immediately surrounding area, such as Williams Creek, which boasts really high median and average incomes, as well as this Meridian Kessler neighborhood, and Broad Ripple, which is kind of that cultural hub of Indianapolis, which is, again, just right down Keystone. Just to the north, you have immediate access to 465, which is the loop that goes around Indy. I guess the Keystone at the Crossing Mall is right here, and then just surrounded by high-paying employers. A lot of real estate companies, to be honest. Charles Schwab, UBS Financial, Somerset CPAs and CBiz, which is our CPA firm, Ruoff Mortgage, etc. A little bit to the west, you'll see the Meridian Street corridor. Again, a lot of financial services firms. And this is, it's probably a 6 to 8 minute drive from Keystone at the Crossing to get to that Meridian Street corridor. And then to get to some of the other major developments, like that Eli Lilly site at the Leap District, you'll find that is located just a little bit northwest up along 65 in Boone County, but it's just a little bit northwest of this map shows. All right, so we've talked about sales comps. So I think we're getting a good deal, but where are rents and where we can take it? Because I think, the one area, if I were you and I was looking at our model and our projected returns, the one pushback, if I were you, I would make is, you're moving rents a little bit too much. How can you justify these rent increases? Okay, we're putting some money into the property, putting some money into the units, but how are you going to move rents like this, especially, when there's a lot of supply coming online, right? Now, supply is going to fall off, but how are we justifying where we're going to be taking these rents? Let's take a look at the comps. And one comment I have on these comparable properties these are true apples to apples comparisons. These are good comps. I know these properties all well personally. I've tried to buy probably half of them, and I know the owners of the other half, or I've just driven by them so much I've watched them be developed. So looking at a per square foot basis, as well as the average rent per unit, you can see that Solana has some of the largest floor plans in the market, averaging around 1,050 square feet per unit. The rents, however, are some of the lowest of the comparable set. And then as I look at this, and just quick, I think the best comp on this is probably this Lake Clearwater. That's our primary target, because it's in the same very nice Washington Township School District, which is the best school district in Indianapolis. It's right around the corner on 82nd Street, same year of construction. So there's no reason why we shouldn't be able to be going head-to-head with Lake Clearwater. Some of these other comps are similar vintage, some a little bit older, some a little bit newer. But as you can see, almost all, besides a few, are much lower on their average rents. And you really have to go look at properties that were built in the 1980s to find rent levels that are comparable, like the Lakeshore Apartments. I'm a limited partner investor in that project, no control or anything. but it's a mid 1980s product. Decent location, down 82nd Street, but not nearly as nice. Further away from the Fashion Mall. They went through renovation, but smaller units, 8-foot ceilings versus the 9 and 12 that Solana has. It's just not a good comparison. But we wanted to have it on there to show you how close Solana is to some of these older comps. Now looking at has a little bit of a history. When we're looking at average rents only right now, there's 3 light gray bars. The first one is the rent roll at Solana back in January when we first were really digging into the deal. The second is an updated rent roll from April. So you can see they've made some progress. They are achieving higher level rents, and actually some of the most recent leases they have signed are much closer to our pro forma, as they've realized they've got a lot of room that they can move in terms of their rents. The story behind that is, and why, because I think reasonably you'd say, why are the rent levels so low? If it's a great location, it's on the river, the units look nice, the rent shouldn't be this low. It's out-of-state owner, out-of-state manager for one. Good owner, not a bad manager, but a lot of low-hanging fruit that's left on the table. But more importantly than that, in last November, as they were kind of going into the slow season, they had a corporate lease a corporation that had 30 leases at the property. That company went bankrupt. They lost all of those leases on the same day. That brought their occupancy down into the 80% range. And I don't want to say they panicked, but they correctly, their decision was to optimize for occupancy. They needed to get heads in beds, and the easiest way to do that, especially going into the winter season, which sometimes you don't get any leases in December, they lowered rents dramatically to try to fill those units up. And so the average rent roll in the unit mix is an average of some of those lower rents from kind of November through February, as well as some of the moderate rents that were prior to the 30 corporate leases going out. They've now reversed course, realizing that they're way under market. So they've been moving the rents up. Again, this is just the difference between January and April across the average of all 384 units. So it takes a lot with 50% on average turnover to start moving that average rent. The third gray bar is at the end of our year one. So looking basically 16 months from now, where we would like to move rents. Again, we are targeting basically matching Lake Clearwater. There's no reason why we should not be able to compete head-to-head with the Quarry, which is behind the Fashion Mall, or Seasons of Carmel, which is down the street on the Carmel side of the line, or the Edge Apartments, which is in Indianapolis, 2024 construction, but less amenities, not nearly the location and the scenery. And if there's no reason why we shouldn't be able to compete, be a few $100s below the Edge Apartments, and basically have all the same finish levels, features, and offer more in terms of livability and lifestyle. Across the board, perfect. Across the board, 1-bedroom rents, again, very low. We see Lakeshore Apartments, again, this is a mid-80s value-add deal. There's no reason Solana should be below. Current management is they're a little bit behind the 8-ball right now. Again, we should be able to compete with Lake Clearwater, which is right here, charging currently, around a little bit more than $1,400 a month. And again, the Edge, the Coil, Seasons of Carmel, Quarry, these are all kind of the higher end of the market that we want to be able to have a $300 spread below. 2 bedrooms, same thing, really same thing. So let's talk about what these units kind of look like, some of the features, and then I'd love to answer some more questions after we discuss the returns a little bit. Again, world-class fitness center, great resident lounge, event center, resort-style pool. It's a great time. They've actually replaced. They just have like these. It looks like they just have kind of your standard pool furniture in the pool. They've got the really nice kind of white chairs that go into the water on the sun deck. Dog park. But then again, we're on the water. But not just are we on the water, but we have 20 boat slips that residents can rent out for $100 a month. They haven't really been activating that. They haven't been encouraging that. They're not really marketing the river and the waterfront amenities like I believe that they should or they could. In part of that, because seeing the river as an absolute amenity that we want to lean into, it's kind of like the icing on the cake. You don't need the river the numbers make sense where the rent levels are. But the river is our X factor that we're going to have over the competition. We're in conversations with a local nonprofit, the Friends of the White River, to work on plans to maintain the shoreline, more cost-effective ways to maintain the shoreline. They're going to do free meetings and workshops with our site staff, our landscaping teams, as well as assist us with applying for some grants potentially to work on some natural plantings along the riverbank that will reduce costs, less to mow, get the geese off the lawn, and in general, so we'll be one of the largest property owners on the White River, which we're very excited for. And again, to just be a part of this community to reactivate the White River, lean into it. And again, this is our X factor that no other apartment community has. And so we want to take advantage of it. What we're going to do, again, I mentioned a little bit of this on our value add plan. New paint scheme on all exterior hardy siding. It is hardy plank siding. It's not wood. And then there's a mix of brick and limestone throughout the rest. We're not going to paint the brick or the limestone. It's in relatively good shape, maybe a little bit of tuck pointing here or there. But as you can see, the color, it's this like buttercream yellow, and it just doesn't do it for me. I'm colorblind though, so I've been asking everyone I know, what do they think? And we need to repaint it again to have a bolder color that pops. But then we want to make sure that the paint the exterior is not in a worse condition 3 or 4 or 5 years from now when we're going to sell it. We want it to look like it is as brand new as it could be, even though it might be 15, 16 years old at the time. It's only 10 years now, and deferred maintenance it's going to start popping up. So we want to take all of the steps to cure that going into it, capitalize it up front, as opposed to in 3 years from now saying, oh, well, now we need to repaint and we're going to have to go find a couple $100,000 to repaint the exterior. No one wants to do that, but it's easy to do if you just plan on it going in. We're going to be expanding the dog park. It could just be a little bit nicer. Not a major expense. We're also going to be adding some more EV charging stations. The property has 2 charging stations right now. It's the right demographic to add them. There are many private direct access garages on site, especially for those condo units. We're going to be exploring adding just the 240 volt, kind of the dryer outlet that you can plug your own charger into. It's charged to your meter. And we're also looking at installing some of the public chargers that residents that don't have a garage that can utilize. We're also going to be adding around 20 these private yards, which are going to be fenced in with turf in the middle. They're going to be off the back patios of some of the first floor units. This is going to add a couple hundred square feet onto these units. Current comps in the area are achieving $200 premiums just on adding these private yards. But if you think about it, it makes sense. If you've got a dog, you've got kids, being able to access your backyard, essentially, giving you a backyard is unique in apartment living. And to be able to provide that, the fence around it, no maintenance because it's going to be turfed. Again, it's just a lifestyle game changer that we've seen executed successfully at nearby properties. We're also going to do new signage and landscaping. Again, this is just going to really just maximize the curb appeal. Keystone Avenue, which I've mentioned, gets 50,000 cars driving by every single day. There is a sign now. It's not as visible as it should be. We need to take full advantage of the traffic that drives by Solana. You can see the property from the road. So we want some really visible signage. And just speaking with the leasing team, I know that they get a lot of referrals in traffic from people just saying, I've seen the apartments on the road. I want to increase that and really lean into that. And that's, at the end of the day, that can be a lot cheaper than spending extra money on more internet advertising, which we do that as well. But a few really nice signs to get that drive-by traffic, because it's on your commute, you're seeing it. I think we need to look at that. We need to harvest that low-hanging fruit. And then in terms of operational improvements, one example, this isn't specifically mentioned on this. Oh yeah, it is at the bottom. They're not using any sort of revenue management system right now, which the rest of the market is. And so if the rest of the market wasn't using revenue management, you could argue that you might not need to use it. But the reason why the rents are suppressed, or one of the other reasons besides those corporate leases, is that they're behind the market. And by implementing revenue management software, we can make sure we are staying on top of the market. You still have to watch it. You can't just let it run and do its thing. It's a suggestion, but we want to use the best technology to be able to make sure that we're not leaving anything on the table. And again, just driving home the marketing, really leaning into the scenery, the river, all of the things that you can do, and have like the best Solana summer this year at your apartment in Indianapolis. The units are already nice. Again, so this is where I think we have there's huge potential, because compared to 2024 built properties, and I'm like looking at the edge apartments that are going in Indianapolis, just 2 miles away from Solana, the interior finishes are very similar. Granite countertops, ceiling fans, double vanities, in-unit washer and dryers. But there's a couple things that I think that might pop out as differences if you toured one of the brand new properties in Solana. And so, what we're going to do essentially, it's kind of a tactical modernization package is what we're calling it. First off, keyless entry across all 384 units. When you've got a physical key, I mean, it just feels like you're going into an older apartment community. Not to mention, no property manager, including Great Residential, likes to manage a bunch of physical keys. We're not living in the 90s anymore. We have keys on our phones. We can use fobs. It's a different experience. Again, it's that perception of being a modern unit, and you're basically getting the same thing as the brand new property. Smart thermostats, same story. Compression, updated unit, modern, great for managing, or great on the management side as well. Kitchens are often what sell any type of real estate. The kitchens already look pretty good, so we look at where are the weak parts on the actual kitchen finishes. The faucet and some of the lighting. The lighting is a little bit outdated. It's often this track lighting, not in every unit, but about half of the floor plans. The lighting really needs to be swapped out. More modern pendant lighting. Again, make the area pop, draw your eye to it. Same thing with the faucet. Currently, there's this like plasticky chrome kitchen faucet that just kind of disappears, and if you actually mess with it, it's just a little bit cheap. It doesn't stand out. We want to put in a statement piece, gooseneck style faucet that again draws the eye. So you're going to drive into Solana, freshly painted, go through the private gate. There is a gate, so it's controlled access as you enter in, which makes the property feel much safer than nearby properties. Great tour. You see the river, you see the bay, the updated clubhouse, the EV chargers, and then you walk into the model unit or your perspective unit, and you see all these upgraded features. You're checking all of the same boxes that you just did when you toured the 2024 built property that's down the road, I guess. But the big difference is, instead of living behind the interstate with no on-ramp, or behind a strip mall, or behind the mall, you're living on the water. It couldn't be more different. As you can tell, I'm so excited for this project. But let's get into the deals. Brass tacks, numbers. Very similar to pretty much all of our other projects. We don't really deviate too much from our structure. That way, if you've done a deal with Great Capital, you basically know what you're going to get. Same team, same general structure. $100,000 minimum, offering an 8% preferred return with a 70-30 split. No additional waterfalls. In terms of fees, these are the same fees we charge on almost every one of our deals. 1.75% acquisition fee. We charge a 0.75% loan guarantee fee, a 0.5% asset management fee, 3% property management fee, and a 5% construction management fee on large construction projects if our great construction team is managing them. But where does that all kind of shake out to in terms of returns? 16.3% internal rate of return projected for LPs, 9.3% average cash on cash over the hold period, and a 2.3x multiple. I don't like to use the AAR. It's not the best metric. So what does that mean for you in terms of yearly distributions? We're starting out of the gate, as I mentioned, planning on distributing 6% cash on cash in the first year. These will be monthly distributions. 6% is an annualized figure. If we can achieve our rent growth, we're going to be in the 8% range by year 2, growing from there, kind of getting into the 10% range as we get closer to the end of our hold period. But we have the big difference in this business plan compared to some others is that we are looking at doing a refinance at some point within the first 4 years of the hold period. We are assuming the current loan on the property, which is a floating rate Fannie Mae loan with 8 years of term remaining in 5 years of interest only. Now, I don't like floating rate debt either, which is why we're going to buy an interest rate cap that'll buy the rate down to 5%. Even though we've got 8 years of term left on the deal, we're really using it as it's not really a bridge loan, but we're essentially going to be refinancing as soon as possible, either as interest rates come down, although they don't need to, or if we can get net operating income up. We don't have to refinance. The deal is not dependent on us refinancing, but I believe strongly that either through increasing net operating income through our business plan and or if interest rates come down a little bit, again, we don't need both to happen. We really don't, and we don't need either to happen in order for the deal to continue and be successful. But again, I don't know when interest rates are going to come down. I don't think they're going to come down that much, but I think they're going to come down a little bit over the next 4 years. I think that's kind of even less than a base case than your most economists who have been wrong typically. But at some point, we're going to swap it out for fixed rate debt. We're targeting in year 4, and that would return quite a bit of capital, around 40% of capital. And so if you look on this chart, and you can get all these charts and this is all in our deck that you can find by going to solanaindy.com, or when you create an account at graycapitalllc.com, log into our portal. We've got this deck, all of these charts and more. Just everything is kind of right there for you. But so if you were investing $100,000, you'd receive $6,000 in the first year, and then we're projecting $8,000 or 8% cash on cash the next year, followed by $8,500, and then that big refinance. Again, this refinance could take place in year 2. Frankly, if rates come down, which I'm not betting on in year 1, we may refinance in year 1. Really, 2 to 4 years is kind of that target window by allowing us to get rents up, move NOI, and then if rates come down, we're looking at a really nice return of about 50% in year 4. Again, that number will change depending on when that actually occurs. If you're wondering about, okay, you guys are modeling refinance, what's going on here? We've included a sensitivity table in the deck for you to take a look at, depending on where net operating income is, where interest rates are. We'll kind of take a look at where some of those refinancing proceeds will actually come out to be. And across the board, even if we get really low NOI growth and interest rates actually increase, we'd still be able to cash out a little bit. So, very confident in ability at some point we will be able to refinance. And we thought it was more appropriate, since it is part of our plan, to refinance in the first couple of years, to include it in the deck, to include it in the model, as opposed to just not including it entirely. So if you have any questions about that, again, feel free to reach out to myself, Blake, Griffin, or anybody on the team itself. Well, all right, as we wrap up, I just want to remind everybody, we are under contract. We're currently raising capital, and all of the documents related to Solana are available on the Gray Capital portal, which you can find at graycapitalllc.com. You can schedule a meeting with myself and members of the Gray Capital team. Happy to walk you through it. But before you do, you can get in there, download the deck, get all your due diligence materials, and if all checks the boxes, you can make your investment, make your commitment right then and there, or alternatively, schedule a meeting with us, get those questions answered. If you feel comfortable with Gray Capital and the deal, you can go ahead and make your commitment while there is still room available. Just again, as a reminder, that window is open, but we are looking to really have all the capital raised within the next 2 weeks or so, and we could have a call the end of this week of it all being taken. Hope that doesn't happen, so more of you can have an opportunity to get in on this project. We're going to be ending our due diligence by June 18th. We'll certainly be done with a capital raise by then. We're going to call the capital really at the beginning of July, and then we'll close before August, probably the last week of July. And again, the plan is to issue our first distribution before August 31st, representing that pro rata share of cash flow for the month. We do always do monthly distributions at Gray Capital, monthly reports, and then a really long report quarterly that includes a video report from myself, kind of going over all the highlights of the deal itself. Okay, let me get to some questions, and I think Blake has been answering some. Let me go through here. All right, Gage. Hey, Spencer. Student studying real estate in LA. Hey, nice to meet you, Gage. I sent you an invitation to connect on LinkedIn. I would love to ask you some questions in the future about your career. Sure thing, Gage. Happy to answer those questions. There's a lot of folks that helped me in my career. As I started, I've been investing in real estate really since I was getting out of high school. So now I've done it for 15, maybe going on. How old am I? I don't know, about 16, 17 years I've been investing in real estate. Got really serious in 2015 after I had sold a business. But I don't have a real estate degree. I've been an entrepreneur. I've worked in several industries from agriculture to media and music. And a lot of folks helped me along the way. I learned from some really smart folks, some really good operators. So I'm always happy to answer any questions and help somebody else who's trying to figure the industry out. Looks like Brett was able to set up a meeting with Blake. That's great to hear. I'm going to go through, make sure. Okay, thank you. Perfect. All right, well, if anybody has any other questions, please feel free to put them in the chat below. Sorry, I just need a quick drink of water. A lot of talking over the last several minutes. All right. Do any new 3-story apartments? So there are some new apartments in the immediate area that Edge Apartments, which is right on Westfield Boulevard, just south of 96th Street, or really right at Westfield and 96. That would be a newer apartment with, they do have some 3 stories. Oh, good. Here's some questions coming in. Francis M. asks, excuse me, is this 70-30 split cash flow or equity? It's actually, it's both. And so for the way our cash flow waterfall works is that if once the 8% preferred return has been caught up, if there's any deferred pref, first we catch up that 8% preferred return. If there's cash flow that exceeds that 8%, it is then split 70-30 to LP or to the 70% to the limited partners, 30% to the GP. On a capital event, first preferred return is made current, then everybody gets all of their money back, and then any remaining proceeds are split 70-30 LP and GP. I've answered that question. Can you please share a few comparisons of recently closed out investments at 7 years, comparing projects at OMs versus actuals? Sure thing. Just go back to our track record real quick. What I don't have on here is what our, this is good. Well, we should include this. So I really appreciate it, RJ. Because we don't have our original kind of pro forma numbers on here. I've never underwritten a deal. We've never done a deal that is, more than a 20 IRR. All of the deals that we underwrite are typically 15 to 17% IRR. A couple have been in the 18% range. As you can see, every deal that we have gone full cycle on is north of 20%. The lowest total return has been around 23% IRR, with the vast majority being kind of north of 30%. Sandra, can you address the new supply in the market and why our business plan does not include directly competing with the new supply, but rather being the next best option? Great question. There's a lot of new supply coming in the market, not just in Indianapolis, but across the country. Excuse me. But Indianapolis, fortunately, we're delivering a lot less compared to markets like the Sun Belt. But that doesn't mean we're not delivering a lot of units. I mean, Indianapolis, we're experiencing deliveries representing around 6% of all existing inventory, and it's about kind of a 35-year high in terms of deliveries. So a lot of pressure right now. We've already seen that show up. In occupancy in Indianapolis is kind of at its like cycle low right now, kind of in the 92-93% range. That's kind of generally Indianapolis hovers in the 93 to 94% range over time. Obviously, occupancies increased during COVID. What we're seeing, let me just pull up this chart. We're seeing the peak of deliveries right now, and we're going to see them kind of through this year, but then tapering off into 2025. And then in 2026, and so I'm just pulling up the right chart here. So as you can see, we're kind of peaking out on deliveries. It moderates in 2025, but then once we get into 2026, we really come down to really low levels of deliveries. Unfortunately, population growth is very strong in Indianapolis, on the north side of Indianapolis. And so we're really experiencing some of that downward pressure kind of like as we speak. I think one of the reasons why we're able to get a pretty good deal on the property itself. I'm less concerned about just because Solana's differentiated factors. They're currently 96% pre-leased to 98%, so they're already beating the market. That's a clear sign to me that their rents are far below. And so our plan is to, execute our business plan, keep moving Solana forward. But we're confident that, all the new deliveries, the rents are going to be materially higher than Solana. Again, just as an example, the Edge Apartments, this is a property that they're just delivering it right now, and they are so far above where Solana is currently. So I'm less concerned about all of the new supply. If anything, it's going to be an example of the differentiate Solana. Now, if they end up lowering their rents by $600, that would be a situation that would be much difficult to manage because in the other question, part of it was the question was, why is the business plan not include directly competing with new supply, but rather being the next best option? Well, first off, if I told everybody we were going to be at the rents of the top of the market, everyone would be, we would just seem way too aggressive. So I want to be a little bit more conservative, saying, what do I know that we can achieve? And it's going to take, and assuming that it's going to take some time to get there. Like, I know that we can do better than Lake Clearwater. Like, absolutely. So the plan is, let's just do, right now, we're going to model and project that we're going to basically just do the same as Lake Clearwater is. But then obviously we're going to keep pushing. And if we can achieve the rents the 2024 deals are, that's great. But I think that's a lot to assume, and I certainly wouldn't want to put that in our projections. But I think it's certainly possible, and that certainly will be the target. What was the worst investment Great Capital did, and why? That's a great question. And what was the best one, and why? Well, there's always one or two properties that have challenges, and some of the worst properties sometimes turn out to be some of the best. So just actually, I've got the case studies to show you at highlight, and I'm going to mention two other properties that we've had struggles with and how we've been able to navigate. And we're coming up right on an hour, so if you have stuck with us in this webinar, I really appreciate it. If you got to head out for lunch, thanks again. But I'm just going to spend a little bit more time so I can answer as many of these questions as possible before I have to head out. And got another interview later on today on the Gray Report that's going to be really exciting to share with you guys later. So Villa's on, well, as far it's not the worst, because it ended up turning out to be one of the best. But Pinnacle on Meridian was one of the first projects that Gray Capital did, and was when we were a lead sponsor. Bought this back in 2020. It was a condo deconversion, 36 units. The floor plans are kind of similar to the ones at Solana. They're very large. There's a floor plan at Solana that's 3,000 square feet. It's incredible. These are all 2,200 square feet units, built as custom condos, really high end. Hadn't been managed well. It was fractured condo communities, so some were rental, some were owned. We dissolved HOA, bought everybody out, and fixed up the property, and it was a huge challenge. We had rebranded the property. No one knew what it was. We went months without getting a lease. It was very challenging. It was just a different asset because we were marketing towards individuals who were looking at the kind of the top of the spectrum rather than in the middle or closer to the bottom. And so getting that word out, how to operate it the right way, was a huge challenge. I had to put a lot of money into this deal kind of halfway through because we went from 90% occupied to 40% occupied after we closed. As we were fixing the property up, again, rebranding, remarketing it. I did a big member loan to the project. It was a non-paying member loan just because I needed an injection of cash. That got us through. We were able to lease up the property, got it to 100% occupancy, figured it out. That's when we started Great Construction and Design, because the construction company that we were working with wasn't doing it. And I said, we got to just do this ourselves. We've got to execute this. Brought on Matt Baxter, who's the director of construction right now, Great Construction and Design. We got it done. Ended up selling it. And again, this is the property that we set the record in Indianapolis for the highest price per unit sale of all time at $414,000 per unit in 2022. Knocked it out of the park. 38% IRR was one of the darkest points in real estate investing for me. It was figuring out how to get these units leased, but we figured it out, and we did it. Best deal, Villas on Fur. It's at the top of the list here. I mentioned this briefly. 2018, 2019 construction. So, core deal, not really nice. Sort of, secondary, tertiary market, South Bend, Indiana, suburb of Granger. We bought this during COVID, peak of COVID. As silly as it sounds, South Bend is a little bit of a drive from Indianapolis and Chicago. And it was in the middle of COVID, so no one was traveling, I guess. So no one was touring the property. No one really knew about Granger. It's right next to Notre Dame University, by the way. Great job growth, really strong incomes. It's like a really attractive, affluent suburb. Everyone wasn't really paying attention, didn't dig into it, and we found out that they were spending an incredible amount of money on concessions, marketing, because they had an issue with some of their heat pumps that they had to replace. And long story short, short-term reputational issue that they turned around, and we got through very easily. We saw a lot of meat on the bone, went in, just reduced some of those expenses, try to manage it a little bit better, more hands-on. That deal has been producing 10% or more cash on cash since the first year of operations. We bought it with a bridge loan. We put a HUD loan on it after holding it for a year. We locked in a 2.73% interest rate fixed for 35 years with a 35-year amortization schedule. So this deal has been distributing 15% cash on cash ever since then. It's one of the easiest properties we have to manage. It leases up very well. It shows well, and it just keeps throwing off cash. What's the biggest risk of just before I get into Steve about the biggest risks, I absolutely want to cover that. Jerry, is there a parking issue at Solana? Are the access roads okay? Parking isn't a major issue at Solana. There's a ton of surface parking throughout the buildings, a couple different parking lots, in addition to there being the direct access garages and private garages for all of the condo and townhome units themselves. There's not a lot. The only issue with parking, when we were there with 15 people last week for our unit inspections, we had to park on the road just outside of the property. But unless you're dealing with a large influx of kind of folks coming from out of the property, even for most of them, if they can park kind of near their guest who's living there, but there are plenty of parking spaces on the property itself. It's just that if there were 20 or 30 people that wanted to all visit at the same time, that would be the challenge. What's the biggest risk with this deal? I think the biggest, I don't think there's a lot of different risks. I would say the one variable that could change the immediate outcome, and it's not really possessing an existential threat risk to the deal, but if we miss our cash flow targets in the first couple of years, our rent bumps, as I mentioned, if the new construction lowers their pro forma rents by $600 or more and really starts directly competing with Solana, I think we can still do pretty well based on our basis and the amenities and the river and all of that. But that's what would be tough, is we wouldn't really be able to achieve that rent growth because I wouldn't. It's not serious for me to make an argument that a 10-year-old property is going to achieve higher rents than the brand new property. That just doesn't happen. So that would be I would say the largest near-term risk. I do see that as a near-term risk, and even if that happens, we have plenty of cash reserve that we always put into all of our deals to get us through any of the times of turmoil. So it would just be we'd have to get through that period. But then just looking historically at any period where we've had kind of oversupply, reduction in rents, there's usually a lot of growth. Historically, every single time after that slowdown, there's quite a bit of rent growth that happens just following. We're not baking any sort of big jump in organic market growth, but historically that has been the case. So I think those are more short-term headwinds. Again, the refinance, we don't have to refinance. I just think that it's a great opportunity, and we most likely will do so in the first several years. What is the rent-income ratio at Solana since your plan anticipate rent increases? Blake mentioned the $1,700, post increases. So I'm just going through to see if Blake's already answered some of these. Basically anyone making over $68,000 per year would be able to live at Solana with average incomes median incomes closer to $80,000 a year. So we're right within the range and not worried about affordability at this property. And really, we're targeting the higher income earners for Solana. It's really not workforce housing, at all. So talking about the rate cap. So we're going to be buying a longer cap than we need to. We could buy like a 1 or 2 year cap. Right now we're modeling, looking at buying a 3 to 4 year cap. And we're bringing all that capital on with some excess reserves for an additional cap in the event we don't refinance. But we would almost certainly refinance, assuming interest rates, don't go way up. And then we would just hold on and stick with our cap. So RJ Lee says, we've not lost any investor money. That is true. It had a bad financial deal for investors. Pinnacle is the worst, still 30% IRR. Is that accurate? So that's our full cycle deals. Just again, full transparency. There's always a deal or two that, we're really focusing on we need to specifically focus and figure this out. We've got a project right now in Indianapolis. It's much more workforce housing on the east side of Indianapolis, Crosswinds Apartments. We've struggled with some collections and delinquency out there, really a ton of fraud. We've had to redo some of our screening practices and systems. That project is still cash flow positive. We've had to reduce our distribution, so we are missing our pro forma on that project. I spent all day there last week on Tuesday. Really, the whole corporate team did, kind of giving the on-site teams a hand. I was there picking up trash. We were painting swing sets and just putting in some sweat equity to save some costs. Confident that we're going to be able to turn that one around and do really well on it. But if I had to tell you, what's the one deal that's not going well, right now, it would be Crosswinds. Now that deal, Crosswinds, was purchased at the absolute top of the market. I think we didn't overpay at the time, but certainly, there's been a 30%, reduction in value of multifamily assets. And we would have loved to maybe pay a little bit less. The long-term prospects we're very confident on. We know we're going to have a successful exit at some point, but that's why we model, long-term holds. That's why I don't do 3-year hold deals or 4-year holds or 2-year holds. Minimum we'll ever do is 5 years because we can get through anything if we capitalize the project going in. Yep. Most people won't tell you about their worst deal going on, by the way. Well, again, thanks for everybody. Any more questions? Get in touch with us, solanaindy.com. That way you can just get into our system, get the deck, get a meeting scheduled. But then to get into the portal, go to greatcapitalllc.com. Get into the deal room. Again, download the deck. We continually upload due diligence materials. And then if everything looks good, you're ready to go, you can make your commitment right there, fund your investment, check the status of your deal, your portfolio, all in the Great Capital portal. But if you've got a couple more questions and you would like to talk to the Great Capital team and myself, love to hear from you. Reach out, schedule a meeting, and we'll talk to you soon. All right, thanks again. Hope you have a great day. Looking forward to partnering with you on Solana. All right, we got some work to do. Thank you.